Welcome to the Property Punch podcast, where we break down the myths, share the moves, and punch through the noise of the Australian property market.
Today, we're tackling a big one. Positive cash flow versus capital growth. This is a question that Washington and the Your Wealth Mental team gets a lot. Right, Dad?
All the time. People want to know, what's the smarter play? Do they want to build capital growth over the long term or invest in properties that actually achieve higher rental yield or cash flow, in other words? People want to know what's more sustainable, and we get it. With the market shifting, it can be the difference between financial stress or financial freedom.
What do you mean by financial stress or financial freedom?
So look, when we talk about financial stress, we are talking about a situation where one has to always worry about money, be it their day-to-day bills or not paying their debts on time, or just getting worried about their financial future so that they're not meeting, a goal that they may want to meet in the long term. And for some people, that can be a very, very worrying situation to be in.
So I'm assuming that everyone's trying to aim for financial freedom.
Correct. And financial freedom is the key. Let's underline financial freedom. For me, I think when we teach our clients about investing in property, making sure that they are, having the right strategy to invest in the property market at the right time, we are actually trying to provide them with financial freedom over the long term. And financial freedom means different things for different people. To me, financial freedom means not having to worry about money at all. So yeah, look, how have you been?
I've been good, thank you. How have you been?
Very good. How are you finding, you're no longer an intern now. You've probably been working here now for a number of months. How are you finding it?
I think it's good. It's very interesting. I do a lot of social media work and I look at the analytics a lot, and it's interesting and good to see the growth in views and likes and subscribers. So yeah, it's good.
And they're growing quite, ever since you joined us, we are seeing exponential numbers of that growth happening.
Right. There is some growth, yes.
Okay, and I understand you are going back to uni very soon?
Yeah, in 2 weeks.
Okay, you're looking forward to that?
Yeah, I am actually.
How many units are you taking up in this next semester?
This semester I'm taking 4 units.
Okay, so the same as last?
Yeah.
Must be hard for you then to juggle between full-time university and probably full-time work as well.
I think last semester I made a routine for myself. So I'm just gonna try to emulate that or replicate it across this semester.
Okay.
But how's work been?
It's been great. We're growing, and we've been working a lot on end of the financial year. So it's a busy time for us and our clients. So that's passed, and now we are working on new challenges, different things. But yeah, it's been good. We've been seeing some stable growth within the business, which is good news for us and probably our clients as well.
Yeah. And have you been on any holidays or taking a well-needed break?
Always a good idea to take one. So yes, we went a few weeks ago, but you know what? We were actually doing work there whilst we were on holidays. So it wasn't a holiday such, because it was kind of, we're not in our office or at home. It was just kind of doing work away from our normal environment where we normally work from.
Mm-hmm. But at least you were trying to relax.
We did. Yes, we did. So today's topic is one that is really looking forward to be discussing today. We often get a lot of questions regarding what we're going to be talking about, and it's something that we also try to really explain the basics of how everything works as far as that's concerned. And it's about strategizing or thinking about, is it capital growth or is it positive cash flow when you're investing in property?
I feel like it's important to first almost define the two. Because for people like me who don't really know the difference between positive cash flow and capital growth, that just sounds like a bunch of fancy property terms. So how about you help us define and explain the difference between positive cash flow and capital growth?
You know what I always do to you? I always put it back on you. So what do you think that means? Can you spell it for me, and probably put my input after you. What do you think, is capital growth if you're buying a property, and also positive cash flow in property? What do you think those terms mean?
Well, from what I've heard from you, I think that positive cash flow would have to mean that you're receiving at least some sort of, I wouldn't say profit, but you're not at a loss. You're getting back more money compared to what you're putting in. And capital growth would be almost more with the long term and the growth of your capital.
Okay. Close?
Yeah.
Let's start with positive cash flow or cash flow itself. So cash flow means that when you invest, that property or that asset that you're holding costs you something to hold it. And there are different costs that are associated with property, for example, which we're talking about this afternoon. For example, you have interest that you pay at the bank because you have a loan. You have maintenance, repairs, council rates, water rates, insurance, and all the other expenses that are associated with holding that property. On the other hand, you are receiving rent from your tenants that are occupying your property. So positive cash flow means that the rent that you're receiving from your tenants is more than the expenses that you're incurring to hold that property.
So I was kind of right. I was
Close.
on the right track.
Close. However, that cash flow can actually be positive, so you can actually be getting more, or it can be negative, where you're getting less. The expenses on that property are more than what you're receiving from the rent, and you end up taking some money out of your pocket to top up, which we're going to explain a bit later on.
Okay, so that's positive, cash flow.
That's cash flow, yeah, which can be positive or negative.
And what about capital growth?
Then capital growth is the increase in value of your property over time.
So it's kind of comparing short-ish term to long term, because I think for something to go up in value, it normally takes quite a while, right? Like a few tens of years.
You're right. So when it comes to cash flow, it's more of a short-term focus because we're talking about what's happening on a regular basis, say every week, every month, or every year. That's cash flow, which is short-term. However, when we're talking about capital growth, it's more of a longer term, where when we talk about longer term in property, we're talking about a period of time of, let's say, at least 10 years. Okay. And that's where you tend to see a considerable amount of capital growth over that long term. When we talk about long term, we're talking about that 10-year period plus.
And is there a difference between maybe like locations of where you would find a positive cash flow kind of property versus a capital growth property, or can they both be anywhere?
So that's a good question. Typically, for you to achieve high capital growth, you will need to have bought in major capital cities. They tend to achieve high capital growth over the long term. So all the major capital cities like Sydney, Melbourne, Brisbane, Perth, you tend to achieve that. And then for positive cash flow properties, you tend to find them in regional areas, like Newcastle, Toowoomba, Thabo, and other regional areas.
And is there a reason for that?
The reason is probably as a result of the cost of buying the property. So in the major capital cities, property tends to be more expensive than in regional areas. So because the cash flow, remember how I said it's associated with the rent that you're receiving. So when you're receiving a certain amount of rent, but that property is costing you more, let's say because for starters it has costed you more to buy it, so it means you've borrowed more money, so it means you're paying more interest at the bank. So that's costing you more money. And other expenses to hold it as well. So you tend to see that positive cash flow or negative cash flow in the capital cities, it's associated mainly to the cost of having, or the cost that you'd have bought that property for in the first instance. That causes, that, I guess, ripple effect of you having to fund or having to be spending more money in holding that property over the long term. So it's to do with the fact that it's more expensive to buy in the capital cities. Then in the regional areas, because the properties are cheaper, so they're not costing you as much, hence, the rent the rent that you receive is covering the expenses as well.
Maybe we should start talking about pros and cons of both positive cash flow and capital growth. So how about you lead us into what are some of the pros for positive cash flow, like positive cash flow strategy?
So positive cash flow properties are more attractive, for instance, in a high interest environment, like where we are in at the moment. Because it means that the more money that you're receiving from rent, you are able to cover the interest that you have to pay at the bank. So it's helping you in your cash flow to make sure that any negatively geared properties some of those expenses can be covered by the rent.
What does negatively geared mean?
Today you're asking very good questions. All the terms are basically intertangled. So when we talk about negative gear, there's negative gear and there's positive gearing as well. So I will explain negatively gearing in the first place and then positive gear. So negative gearing is whereby the rent that you're receiving from your tenants is way, way less than the expenses that you are incurring on that property.
Correlates to cash flow.
Exactly. So it's more like overall, the negative cash flow is part of the negative gearing.
Okay.
Yeah. Yes. And then the positively geared is just the opposite. It means that the rent that you receive is more than the expenses that you're incurring to hold that property. So those terms are very, very interchangeable. They're very, very similar, which we're going to explore a little bit later on as well.
So when you have a positive cash flow property, then I'll assume that since the rent is more than the expenses that you put in, you're kind of getting a profit. It gives you financial breathing room.
It does. It does give you, a financial breathing room. However, it's important to understand that the positive cash flow that you be receiving is taxable. You have to pay tax on whatever that amount is. The taxman is always looking at getting some benefits out of you. However, on the other hand, if it's negatively geared or if it's negative cash flow, then there are some tax breaks that you can enjoy by reducing your tax on a yearly basis.
So you can kind of say that they're kind of considerate in that regard, but they give you a tax break if it's negatively.
That's right.
geared.
That's right. So in other words, I always say the government is helping you to be able to hold your property for the long term. Whilst you're waiting for the capital growth, the government on the way is actually assisting you for you to be able to afford to hold that property because you are reducing the amount of tax that you pay.
Interesting. So would there be any cons to a positive cash flow property strategy?
The main one is the one that we just explored, which is the tax.
Okay.
So it means if you, particularly those that are on a higher tax bracket, it just means that profit that they are receiving or that positive cash flow that they are receiving, they could be paying, if they're on the highest marginal tax bracket, they're paying close to half of that in tax. The other con is that if you're going to be chasing on positive cash flow, because you're not buying in major capital cities, you're probably buying in regional areas, and the growth is slower. So you might end up having a property where it's not really growing as much as you'd want it to grow.
Okay. Which means worse capital growth or slower growth over the long term.
Correct.
Value.
Something has to give.
So now capital growth, which you described earlier, was more of your long-term strategy where you have to hold the property for maybe 10 or more years and it has the potential to double in value.
Correct. Over the long term, it could double in value, even more. And you're playing a long-term game. It is a long-term game. And you have to be strategic about what you're buying. So make sure that if you're buying in the capital cities, you're buying near public transport, near infrastructure, roads, schools, hospitals, because those are the factors that will make your property grow in value.
Okay. So are there any distinct pros and cons of capital growth or capital growth strategy?
So because it's costing you a lot of money to hold that property, because you have to top up, whatever you're receiving from tenants is not enough, you have to top up. So that can actually hurt you on your pocket, on your cash flow. And as a result, that might actually slow you down to build your property portfolio. Because let's say you've got one that is hitting your pocket, that may actually be very difficult for you to get another one, because otherwise it'll be double hitting your pocket. And even banks, when they are providing you with an additional loan, they will look at how much money you're using from your own pocket to be funding the first property first. So that's its advantage, I guess, for negatively geared or negative cash flow properties.
Okay. And then I'm assuming the pro would be over the long term, you'd see maybe greater growth or greater increase in value.
You will definitely. And for the longer term, most investors, particularly those that don't really need an instant income, because maybe they are fully employed and they're earning a good income, and they don't really need the immediate income. So their focus is more on building wealth over the long term. So definitely, that's the advantage of capital growth properties.
So what does this mean for property this year? We're halfway through 2025, and there's lots of talk of property markets and how they're changing, like vacancy rates and interest rates are affecting how people are planning and strategizing. So how does positive cash flow and capital growth kind of change or impact someone's outlook on the market?
I heard you say a term there that I'm sure our listeners and viewers would want to know more. What is vacancy rate?
To me, vacancy rate is how many empty properties there are.
Oh, okay.
I hope.
Yeah, it is correct. It is correct. It's close to correct. So yeah, definitely, it's a measure of how many properties there are in a particular market as a percentage or as a ratio of all the properties that are there that are available for rent. Yeah. So as an investor, do you reckon if you are investing your own money yourself, you would want to invest in a positive cash flow or negative cash flow property yourself?
Well, if we're talking about me right now, I feel like I can see an upside to doing both. Because
Okay.
a positive cash flow means that I get money pretty much now or within the near future. And who doesn't love more money now?
Okay.
But then capital growth is for when I'm older and building that wealth. It will probably, when I access it in 30, 40 years down the line, it would probably have increased in value a lot.
Okay.
So I kind of see an upside to both. So I can only choose one.
Okay. Fair
What
answer.
about you?
So
Or what have you done?
what have I done? So look, and we're going to talk a little bit more about this, but what we have done is we are building a strategy where we are trying to achieve both. We're trying to achieve both capital growth over the long term, but so that we can increase our portfolio in a sustainable way, we're also looking for opportunities that are providing with positive cash flow as well. So that positive cash flow is actually helping to fund for the negative cash flow properties. Yeah, however, because right now we don't really need an income from the properties that we are investing in for our day-to-day living expenses, we're just doing that so that the portfolio itself looks after itself, rather than us having to rely on the income from those properties to pay for our day-to-day bills. However, that time is going to come when we retire. Because when we retire, we'll stop earning an income, then hopefully whatever we're investing will be a passive income. So by then, that's when we'll be probably rearranging the portfolio a little bit to now provide us with just the cash flow to pay our day-to-day bills.
Okay.
I got another, I guess, question that you mentioned, the word vacancy rate. So if you're an investor, Where would you invest in a suburb that has got higher vacancy rate or lower vacancy rate? Now that you've explained to us what the vacancy rate, like what vacancy rate is.
Well, even though someone that has a high vacancy rate would have more available I don't know why you'd want to invest somewhere where there's nobody living there. So I would personally go for somewhere with low vacancy rates.
Okay. So in other words, when someone is looking for their next investment property, it's important to know the vacancy rate so that they can, as a starting point, invest in an area where there is lower vacancy rate. Okay. Yeah, good.
So I'm a professional, basically.
Getting there, close. The right property growth properties are back in play, but timing is the key. If you buy at the wrong time, you might hold a flat property for the next 3 to 5 years.
So I also feel like there's some customizing that can happen with the strategy you choose. Like you talked about how you have you and mum are kind of customizing it for your needs. So you can't really copy a strategy or someone else's strategy because it might not suit or be tailored for you and what you financially need in your financial goals.
So that's correct. We all got different personal situations with different age, different incomes, and different goals altogether. So someone, when they're a bit younger, say they're on a higher income, they're single, they don't have a lot of expenses, no family, you might find out that it's important for them to buy property in capital cities that is going to grow in value, and they've got the disposable income to top up for a negative cash flow. And those properties are going to provide them with a huge capital growth over the future. Whereas on the other hand, someone, let's say, about to retire, in their, say, 50s or 60s, then it could be important for them to now consider properties that are actually providing them with positive cash flow so that that can complement their income in the way or into retirement so that that can help with, supplementing their expenses.
So I guess people need to ask themselves, what are they after? What are they looking for? Are they after income now or trying to build wealth over the long term? Are they into what's their risk appetite like? And maybe what they see for themselves down the line.
You've got to ask yourself, am I after income now or build wealth later? What's my risk appetite, as you said? Do I hold one property for 10 years or am I building a portfolio with more properties over the long term?
So as you said, you can have a hybrid kind of approach where you can incorporate both positive cash flow strategies with capital growth properties or property types.
Yes, absolutely. And that's my favorite strategy. So you can definitely, within your portfolio, mix assets between those that are giving you good capital growth as well as positive cash flow. Because remember, the good capital growth often negative cash flow properties. So you also have to have those that are providing you positive cash flow so that they can be paying or supplementing the negative cash flow. Yes, absolutely right.
Interesting.
For example, you might buy a high yield duplex in a regional area that would supplement the rental income from a good capital growth area like in Brisbane, in Melbourne, or even in Sydney. That way you balance the risk, the income, and the equity. We have helped dozens of clients with this strategy. It's not about picking sides. It's about creating a property strategy that aligns with your long-term goals.
So apart from yourself and your own portfolio and what you've done, do you have any examples of clients maybe using this strategy, either one or the other or the hybrid?
Yeah. Oh, yes, definitely. I have an example. We have a client of ours. She's a teacher, single mom on a single income. We managed to get a dual key property in regional Victoria, and she's getting a good rental yield of around 5.7%. So that's helping her to cover all expenses for that property so that she's not topping up on anything at all. And then what she did 12 months later, she leveraged on that property where she bought another one in Queensland. And this property is actually on a roadmap to create good capital growth over the long term.
So that's kind of use of that hybrid structure of using both.
That's exactly what she did, yes. Another example is we had another couple that secured a positive cash flow within their self-managed super fund, and they needed this so that they could use that positive cash flow to pay off the loan in the superannuation, and that's working well for them.
Oh, interesting. So can they use that cash flow gained from their SMSF investment property to support their next, maybe outside of SMSF
Good question.
investment?
Unfortunately, they can't. So whenever you're investing your properties in superannuation, any profits or any proceeds that you get over the long term, you can only reinvest them back into superannuation.
Right.
You cannot take any money out to buy on your own personal name, not up until you retire. So they're
Why is
unable to
that?
do that.
Do you know why?
Yes, I do. So the government has put rules around superannuation, including self-managed super funds, to make sure that the investment is preserved for the sole purpose of investing for your retirement.
Okay.
So that when you retire, you've got enough money in your super to be self-sufficient. So, positive cash flow versus capital growth, which strategy wins? The answer is, it depends on you. The best strategy is when you can hold KO and sleep well at night with.
If you're unsure where to start or which route to take, the team at Your Wealth Mentor has got your back. Head to yourwealthmentor.com.au and book your complimentary property strategy call.
Join the movement of everyday Australians, building real wealth with the right support and smarter strategies. Don't forget to subscribe, leave us a review, and share this episode with someone who needs to hear it.
This has been another episode of the Property Punch podcast. See you next week, where we keep it light, real, and property smart. Sip smart, invest better.